The oil market is in a state of flux. Prices have been declining, a trend driven by multiple factors. Understanding these factors is crucial for investors and policymakers alike. The global energy landscape is undergoing a profound transformation. Supply and demand dynamics are shifting rapidly. OPEC Plus, the cartel of oil-producing nations, has been trying to control the market. Their main tool: production cuts. However, the effectiveness of these cuts is debatable. Other factors are also at play. These factors include tariff negotiations and geopolitical risks. The interplay of these forces creates a complex and ever-changing market. One cannot ignore the rise of non-OPEC production. Countries like the United States are pumping oil at record levels. This surge in output adds another layer of complexity to the global oil market. Demand, too, plays a crucial role. While global demand is growing, the pace of growth is slowing. The future of oil is uncertain. The rise of electric vehicles and renewable energy sources poses a long-term challenge. As the world transitions to cleaner energy, the demand for oil could decline. This transition will have profound implications for the global economy. The Organization of the Petroleum Exporting Countries, OPEC, and its allies, known as OPEC Plus, have been actively managing the oil market. Since April 2023, OPEC Plus has implemented production cuts to stabilize oil prices. However, Brent crude oil prices have fallen despite these cuts. Prices dropped from $85 per barrel in April 2023 to $74 in December 2024. Other factors, like increased refined fuel exports, offset the cuts. OPEC Plus exported a record 5.51 million barrels per day in 2024. This strategy helps generate revenue and gain market share. Yet some members question the effectiveness of continued cuts. Disagreements could undermine OPEC Plus market influence. Tariff negotiations, particularly between the United States and China, have added another layer of uncertainty to the oil market. In April 2025, these two economic giants resumed tariff talks. Oil is among the many goods subject to these discussions. The outcome of these negotiations could significantly impact oil prices. If the US and China agree to reduce tariffs, it could boost global trade. Increased trade activity often leads to higher demand for oil, potentially pushing prices upward. Conversely, a failure to reach an agreement or an escalation of trade tensions could dampen oil demand and exert downward pressure on prices. The oil market is highly sensitive to geopolitical events. Trade wars and tariff disputes introduce a significant element of uncertainty. These uncertainties make it challenging for market participants to accurately forecast future price movements. The oil market is in a state of heightened volatility. Section 4. Global production and demand. Beyond OPEC Plus, a world of production. While OPEC Plus plays a significant role in the oil market, non-OPEC production is also a crucial factor. Production from countries outside of the cartel, particularly in North and South America, is expected to grow substantially in the coming years. This growth in non-OPEC supply is putting downward pressure on prices. Even as OPEC Plus cuts production, increased output from other regions is offsetting these cuts. This dynamic highlights the limitations of OPEC's influence in a market with multiple producers. On the demand side, global oil consumption is still growing. However, the pace of growth is slowing down. This slowdown is partly due to weaker economic growth in some regions. Additionally, the ongoing transition to cleaner energy sources is starting to impact oil demand. China, a major consumer of oil, has seen its demand growth slow significantly. This slowdown is attributed to the country's economic slowdown and its efforts to promote renewable energy. Weak demand from China is a key factor contributing to lower oil prices. Section 5. The American oil engine. The United States has emerged as a major player in the global oil market. The shale revolution has unlocked vast reserves of oil and natural gas in the US. This has led to a surge in American oil production in recent years. US oil output is projected to reach an all-time high of 13.5 million barrels per day in 2025. Production is expected to increase slightly to 13.6 million barrels per day in 2026. However, growth is projected to slow down after 2026 due to reduced drilling activity and natural decline rates in existing wells. The rise of US oil production has significant implications for the global market. Increased American output reduces the need for imports. It also gives the US more leverage in geopolitical negotiations. The US is now a major exporter of oil and refined products, competing with OPEC Plus for market share. Section 6. Geopolitics, the wild card. Geopolitical events can have a significant impact on the oil market. Tensions in the Middle East, a major oil-producing region, always have the potential to disrupt supplies. Any escalation of conflict or political instability in the region could lead to price spikes. The ongoing conflict between Russia and Ukraine has also created uncertainty in the oil market. Western sanctions on Russia, a major oil exporter, have disrupted global supply chains. These disruptions have contributed to price volatility. The oil market is particularly sensitive to events that threaten shipping lanes or production facilities. Terrorist attacks, political unrest, or natural disasters in key oil-producing regions can all lead to supply disruptions. These disruptions can cause price spikes and market instability. Section 7. The future of energy, a long view. The long-term outlook for oil demand is uncertain. Several factors suggest that oil demand may peak in the coming decades. The most significant factor is the global transition to cleaner energy sources. Electric vehicles are becoming increasingly popular. As battery technology improves and costs decline, electric vehicles are becoming a viable alternative to gasoline-powered cars. This shift away from gasoline will inevitably impact oil demand. At the same time, investments in renewable energy are surging. Solar and wind power are becoming increasingly cost-competitive with fossil fuels. As the world transitions to a more sustainable energy mix, the demand for oil is likely to decline. The pace of this transition is uncertain. Government policies, technological advancements, and consumer preferences will all play a role in shaping the future of energy. However, the long-term trend is clear. The world is moving towards a cleaner energy future.